right, welcome back, class. So today we are going to be doing the chapter 9 and 10, as well as chapter 11 review. Just because this week we have an exam that's coming up, so let's get some review going on so we can practice this so then we are ready for the exam. So again, the exam is this Thursday. Tomorrow we're going to go over the study guide. So this is just extra problems for you to just continue to review. So let's go ahead and get started with the chapter 9 review and 10 review. So first we have here is we're going to be dealing with petty cash because that was chapter 9. Okay, so here the example says on number 1 that on January 1st, you opened your store and needed a petty cash fund for emergency expenses. Okay, and then of course you establish that $500 should be enough for the first month of operations. Okay, so let's go ahead and journalize this entry here. So because we're establishing a petty cash fund, right? In this case, it's going to be January 1st. When we establish a petty cash fund, we're going to automatically create the ledger account. And we're going to also create that account, and it's going to be called petty cash. And of course, this money is going to be taken out directly from our checking account. Okay, and again, if you want some extra details or extra notes here, you can type in that you are establish a petty or establish petty cash. Okay, and again, this time it's going to be for $500. Okay, so now that we have that part done, right? The next part question says here for question number 2, at the end of the month, you counted all of the receipts in the petty cash drawer. Okay. Okay, so then the question says that you had a total of $40.03 left in cash remaining. Replenish the petty cash fund. So in this case, here's a list of all of the expenses that occurred. So again, since we established on January 1st that we had $500, this is what the petty cash manager is responsible for. They're responsible to record the date that a person has taken money out. So in this case, the names are here. So Drew was the first person who took money out, and he went to go buy office supplies. Okay, and again, he borrowed $20 and gave back a receipt for $19.85 with the exact change of 15 cents. So here's the account balance at the end of the day. So let's take a look at this, that we should have $40.03 left in my petty cash drawer. So in this case, what is going to be my grand total amount here? Well, let's go ahead and list out all the expenses that occurred this month. So starting on January 31st, right, it's the end of the month, we're going to be listing out all the expenses that it has occurred, right? Because at the end of the day, what this means is that we're going to be recognizing the expense that's happened, and we're going to replenish the petty cash drawer, okay? So as this petty cash drawer was being used, the expenses were not being recorded. So now that it's at the end of the month, this is where we're going to start recognizing our information. So the very first one right here, we have an office supplies expense. Okay, so again, we're going to type in here that's our very first amount here, which is our office supplies expense. Okay, and there we have it. And for this one, again, expenses are always debited, and this one was debited for $19. Okay, let's see what the next expense was let's see who was the next person. The next person was Susan. She ended up doing a business expense. So there you go, business expense for a total of $54.17. Okay, And then let's see what else happened next. We had Mary do a meals expense. So she probably bought meals for a meeting or something like that. Something she provided. She borrowed the company's money to provide a meal for they had a training going on, so they had to provide meals. So in this case, she spent $35.22. Okay. Let's see what the next expense account is. So then Harry he was in charge of delivery, so there you go. He incurred a delivery charge, okay, for the amount of, let's see what the delivery charge was, for $50, okay. And then let's see what happened here. On the 15th of January, Harry once again borrowed money to do another business expense for $22.78. So in this case, we already have a business expense account, right? We have one for $54.17. In this case, right, we need to add this together because this was considered a business expense. So here, 54 plus the business expense of $22.78. Therefore, I get a grand total of $76.95. Okay. All right, so then let's see what happens next. Then on the same day, 15th of June, Drew borrowed another $10 to buy more office supplies expense for $6.95. So we already have an office supplies expense account for $19.85. So we're going to take the $19.85 and we're going to add that $6.99 to get a grand total of $26.80. Okay. So then on the 18th, Mary borrowed money to pay for a delivery expense for $100. So in this case, delivery charges, we have delivery expense right here for $50, right? Since Mary borrowed another additional, we're going to add the $50 to the 100 to get a total of $150. Okay. So then on the 20th of January, Susan borrowed money to pay for advertising expense for $50. So in this case, right, Susan borrowed money for advertising expense for a total of $50. Right? Then we have Harry once again on the 22nd of January. He borrowed more money for another delivery expense. So delivery expenses, here it is. Okay. So we have 150 plus 25. Okay. Gives you 175. All right. Then, let's see, on the 27th of January, Susan borrowed money once again to create a business expense, and it was for $30.33. So, business expense, right now, it's $76.95. Let's see, let's go ahead and add up that. So, we have the $54.17. We have the $22.78 plus a business expense of $30.33 to give me a grand total of $107.28 in business expenses. Last but not least, the owner decided to take money away from the petty cash drawer. Maybe needed some change to go buy some stuff. So on January 31st, the last transaction here in the petty cash drawer is going to be a withdrawal for a total of $50. So again, withdraw for $50. Okay? And then again, the rule is we're going to recognize all the receipts, right? All the expenses, and we're going to write a check out to the petty cash drawer for the total amount of receipts. So in this case, I'm going to go ahead and use my equal sum, and I get a grand total of $444.30. Now, that does not seem right. Let's take a look at that. So 444.30 plus the $40.03 gives me a total of 484 cents. So therefore, I have a total of, I'm missing money. So let's go ahead and go back up here again, and let's actually calculate the total amount of receipts. So let's go ahead and do that real quick. Equal sum here. Okay. Total amount of receipts should be $459.97. So therefore, I have a discrepancy. So I must have made a mistake somewhere. So let's double check our work here. Okay. For office supplies, let's take a look. We have one office supplies here and one office supplies here. So let's go ahead and add those numbers again. So, let's see, 1985 plus plus office supplies for $16.99 should be $26. Maybe I'm having a feeling it's in the business expenses. So here we have a total of 3 business expenses, right? One for the $54.17. Another one for $22.78, and then our last business expense was for $30.33. So therefore, there's 107. Okay. The meals. Okay, let's see. I think we only have one meals expense. Yes, one meals expense right here for a total of $35.22. Excuse me. Okay. Let's try delivery expenses. Maybe that's where we went wrong. Okay. So delivery expenses. Let's see. We have our first delivery expense right here for $50. Okay. Plus delivery expenses right here for $100. Plus we borrowed another delivery expense for $25 to give you $175. Okay, advertising expense was for $50. And again, we borrowed money for $50. So, let's run my formula once again. I still get $444, where this one says $459, and they'll use the exact same numbers. Oh, I missed the meals. So I have a meal that I missed right here for $15.67. So the good meals expense is actually going to be 2 of them, right? We got 35 plus this $15 worth of meals. And there you go. Now I get a total of 459.97, which if I add up my total amount of cash remaining, I get exactly $500. Okay, so there you go. And again, your note could be to replenish penny cash as of January 31st. Okay, so there you go. All right. Question number 3 says on June 1st, okay, your business began to pick up, and the last few months you were running low on the low in the petty cash. Okay. So in this case, you decided to increase the amount by $300. Okay, so record this entry. So once again, if you remember from chapter 9, the way that we increase the account is by increasing the account. So you're going to increase your petty cash and you're going to, of course, write a check for $300. Okay. And I'm going to make a note here. Increase petty cash. Okay. And then question number 4 says here, at the end of the year, you decided to get rid of the petty cash drawer and use a business credit card, okay, for all minor expenses. Record the closing of the petty cash drawer. So since this is all a continuation, it's now December 31st, right, the end of the year. We need to close out our petty cash drawer by emptying it out into my checking account. So I'm going to debit my debit my checking, and then getting rid of my petty cash by zeroing it out. So in this case, I had 500 to begin with, and I increased it by 300. So therefore, my total amount should be 800. And my note here is going to say to close out, excuse me, petty cash drawer. Okay. And that's it for the first 4 questions. Okay. Now in this case, what I'm going to ask you for the exam is going to be similar to this, where I'm going to ask you to either know how to establish, how to close out a petty cash drawer, and how to replenish a petty cash drawer, okay? So, question number 5, okay? And 5 all the way to 10, they're all going to be related. So in this case, this is in regards to receivables, right? All right, so let's go ahead and take a look at this example. So question number 5 says that on June 15, customer A decides to purchase a total of 100 toys for $5 each on an account. Okay, sales tax is 8.25%. Record this transaction. So the first one is on June 15. June 15. Okay. June 15, customer A purchased a total of 100 toys at $5 each on an account. So if it's on an account, this is going to be accounts receivable. Okay, for what was it, $5, and then they bought 100 of them. So again, that doesn't go there. That's for sales. Okay, so sales was $500. Okay, right? We're going to record sales. And we're going to also record sales tax. That's going to be included. Okay, so sales tax is going to be 8.25% of this. So I'm going to do an equal round. Right? Times 0.825, comma 2. And that should give me a total of $41.25 to give me a grand total of accounts receivable to be owed is $541.25. Okay, so in this case, that is that. All right, and then I'm going to make a note here that customer A buys 100 toys at $5 each. Okay. So then number 6 says that on July 15, okay, we received a payment check of $50 from customer A. Record this transaction. So we received $50, right? So in this case, on, what was it, July 15, so exactly a month later, we received money from customer A. In this case, since we received money, right, and we received a check, it's going to automatically go into our checking account, okay? And it's going to reduce the accounts receivable, okay, by $50, right? And then I'm going to go ahead and make a note here that I received payment from customer A. Okay. Okay. So then that was that. So then let's see what happens next for question number 7. Then August 15, customer A refuses to pay the remaining amount she owes. Okay, so record this transaction. So if customer A decides to not pay and decides to just not pay, right? It becomes potential bad debt. So in this case, for this one, this is August 15. Since customer A is refusing to pay, we need to place it in an account to reflect that this person is not going to make a payment or it's potential bad debt. So there we're going to have allowance for doubtful accounts. All right? And then in this case, it's going to be removed directly from our accounts receivable account because this is potential debt that we might not be able to collect. So in this case, we are making a note here that this is the amount. And again, if it's a grand total amount was originally $541.21 and customer A made a payment for that $50, that means, oops, yeah, they owe me $491.50. Or sorry, 25 cents. Okay, and then I'm going to make a note here. In this case, to write off customer A's accounts receivable balance. Okay. So then question 8 says that, okay, so we contacted customer A to receive the debt that she owes. So then on October 20th, okay, we end up receiving another payment for $15 from customer A. Record this transaction. Okay? In this case, right, our potential bad debt is currently in the allowance for doubtful accounts. Because we actively moved that amount over, we need to undo it in order to make it active again. Okay, so in this case right now, this doesn't even exist in accounts receivable anymore because it's potential bad debt. It's getting ready to be collected some other time. But then on October 20th, what happens here is that, well, customer A decided to make a small payment. So in this case, you're going to reactivate it, accounts receivable, okay, for the same amount of the $491.25, okay, and we're going to undo this so then now it's becoming active again, right? Okay, so there you go for the same amount. Okay. All right, and then we can go ahead and record the payment because we received another check from customer A, right, on October 20th for a total amount of $15. So in this case, right, since we received a payment, I'm assuming it's a check, so therefore it's going to decrease the accounts receivable. Okay. So again, wrote $15 check. So now that's going to decrease my accounts receivable by $15. Okay. So then here you go. Question number 9 says that then on November 28th, a debt collector informed that customer A has filed for bankruptcy and can no longer make payments. Okay. So then let's go ahead and record this transaction. So now we have a conclusion. We have the result here is that it is a guaranteed bad debt, that because a debt collector called us and said, well, this person can no longer pay, so therefore it's going to become completely uncollectible. So in this case, we're going to remove it into the allowance for doubtful accounts because we know exactly who and we know exactly when it happened. It happened on November 28th. Okay. And of course, because we're removing this from the account receivable, right? We're removing her bad debt out from the accounts receivable because the accounts receivable has everybody else in it. And so this time the amount's going to be the $491.25 minus $15 will give you $476.25. Okay. So then last but not least, question number 10 says that on December 31st, a company estimated that $2,556 out of its 200,000 accounts receivable is to be uncollectible. There's currently a debit balance for $476.25 in the allowance for doubtful accounts account. So record this allowance. So once again, or record this adjustment. So once again, this is the process of how you get a debit, or a credit balance in your allowance for doubtful accounts, right? The last thing that we did was we debited the account for the $476.25. So this is where we're going to start writing it off. So again, it is December 31st, right? End of the year. So how do we write off bad debt? Okay, since it's the end of the year, and this is an estimated amount, we're going to associate this with the bad debt expense account, right? And we're going to credit our allowance, okay, for doubtful accounts, just like what we've been doing over and over, okay? And this time, my end goal is I'm trying to get to $2,556. Okay, and I have a debit balance of $476.25. In this case, right, I'm on the debit side. I need to get to a credit balance of $2,556 on the allowance for doubtful accounts account. So in this case, I'm going to do what I have to do is add these two numbers together, right, to get a grand total of $3,032.25. Because if you remember, let's analyze that quote one more time, or that problem. I have an estimated amount of $2,556, right? The key word here is accounts receivable. This means we're using the balance sheet method. So in the balance sheet method, it tells you that yes, the allowance for doubtful accounts does appear on the balance sheet. So in this case, we're going to add the $476.25 because it's currently a debit balance. Debit tells you to add, credit tells you to subtract. So by adding these two numbers together, you're going to get $3,032.25. All right, and that's how we deal with bad debt. Okay. All right. So let's go ahead and take a look at examples number 11 through 14. which is going to show us how to be able to write off bad debt using the bad debt expense account, right? We're writing basically the adjustments here. So let's practice these 4 questions here. So the 11th says that on December 31st, okay, your company estimates that $2,430 of its $500,000 total credit sales, okay, that's the key word there. Total credit sales is to be uncollectible, okay, and there's currently a debit balance of $1,500 in the allowance for doubtful accounts. Now in this case, right, when we see the word total credit sales, we immediately think about the income statement, because on the income statement, the allowance for doubtful accounts doesn't even appear. Nor does the accounts receivable account. All right. So therefore, I can safely assume this is the income statement method, which tells me that when I write my bad debt expense off, right, I'm going to write it off for the total estimated amount, right? And that's going to credit my allowance for doubtful accounts, okay, for the total of $2,430. $2,430. Okay. Then question number 12 says, on December 31st, your company estimates that $2,430 out of its 500,000 accounts receivable. There you go. Here's the word accounts receivable. That immediately sparks that we're using the balance sheet method. So we do care about what amount is going to be in the allowance for doubtful accounts. In this case, there's currently a debit balance of $1,500. Okay? Debit indicates that we need to add. All right? So again, the journal is going to look identical. So I'm going to save some time here and copy and paste. But this time, right, because I have a debit balance in my allowance for doubtful accounts, I need to add $2,430 to the $1,500 to get a grand total of $3,930 as my total amount that I'm going to be debiting into my bad debt expense account. Okay. Then on December 30, on the 13th, I'm at the 13th question here. On December 31st, your company estimates that $2,430 of its $500,000 accounts receivable, so here you go, accounts receivable, is currently uncollectible. There's currently a credit balance of $1,500. Okay? So once again, the journal entry is going to be the same exact thing, but this time, right, we have a credit balance. If I'm already on the credit side in my allowance for doubtful accounts, right, and my end goal is to get to 2,430, right, 2,430, I need to subtract this because I already have 1,500 in my allowance for doubtful accounts already. So therefore, I only need to debit a total of $930 towards my allowance for doubtful accounts to give me a grand total of $2,430 in my allowance for doubtful accounts account. Okay. Last but not least, all right, question number 14. December 31st, your company estimates that 2,430 of its 500,000 total credit sales. Right there, you could stop here because, again, you don't need to care about whether there's an account balance in the allowance for doubtful accounts because this is the income statement. So if you're able to recognize that and just stop there, then all you need here is just the estimated amount here, because that's the rule here. The journal's going to look the same, but the idea here is that it's going to be for the estimated amount of $2,430. Okay? All right. So once again, that was question 14. All right, practicing this. So this is a good example for you to practice for the exam because I will test you on knowing the difference between the both methods of using either the income statement method or the balance sheet method. So make sure you are aware. Okay. So question 15 here, we have a set of information here. So in this case, right, I believe this one is going to be an example of a simple interest, if I'm not mistaken. Or in this case, let's take a look at the actual question here. Okay, so let me see. This is chapter 9 and 10. Question here. Okay. So assume that you are using simple interest, I believe. Here you go. So question 15. Oh, of course, it's obvious, right? Because we don't have that one component, which is the number of times compounded. So in this case, right here, you should automatically assume this is simple interest because you don't have that extra n in there. So in this case, let's go ahead and practice our numbers here. So in order to solve for interest, which is PRT, P is going to be your principal, so 28,000 times 4.35% times, and this time it's in 150 days. Well, 150 days, right, in terms of months, right? So if 30 days is equal to 1 month, okay, then 150 days is equal to 5 months, right? So 30 times 5 gives you 150 days. So in this case, it's 5 months. So 5 months out of a whole entire year is going to give you a total of $507.50 of interest. So that means your future value is going to be your principal plus your interest of $507.50 to give you $28,507.50. Okay. All right, let's go ahead and do the second one. Second one says you have a principal of $5,147.50. The interest rate is 6%. And then, of course, the number of years is 10 because it's 10 years. So in this case, you're going to get a grand total of $3,088.50, which you add this to your principal to give you a future value of $8,236. Okay. Last example here is going to be if I have a interest, right? Interest of 3.49%, right? So let's go ahead and calculate this. So again, principal times rate times time. So your principal here is the $684,150 times the percentage of 3.49%. Times, this time it's 8 months out of 12, which should give you a total of $15,000. Okay, you're going to add that to your principal, and you are going to get a total of $700,067.89. Okay. All right. So on the exam, you will be only tested simple interest because I can't assume that everybody knows how to use Excel, and I can't also assume that you guys are going to have the expensive graphing calculator. Okay, so in this case, if you're able to just find the simple interest, right? And I could ask you either or. How much interest are you going to be collecting after X amount of years? Or another case, I could say, what is the total value of the bond in 5 years, right? So that's good to ask you for the future value. All right. Okay, last question here is question number 16, where it's going to be a great example of a bank reconciliation. So as I've mentioned this many times before, you guys are only going to be responsible for knowing the do's and the ifs, right? On the bank side, you're only focusing on your do's, which is your deposits in transit and your outstanding checks, while on your cash side, you're only going to be dealing with your ifs, which is your interest and your fees. So this is going to be what a great example of what it should look like. I'm going to give you a table that's your bank account, and then a table that's your checking account, and then another table for you to be able to solve for the adjustments here. So I'm going to go ahead and make this a little bigger so we are able to kind of view it a little better. Okay. So as you can see here, my bank statement is right here with my ending bank balance as of May 31st, okay? It's going to be $850, okay? So let's go ahead, and I'll go ahead and do the bank side since I already mentioned here that the bank, right, the ending balance is $850, okay? Now, the first thing we're going to add is any deposits in transit. So let's take a look at our checking account, and then we'll compare it to our bank account. So checking account, our deposits is 44, 45, 46, and 47. Let's see what the bank says. The bank says it's recognized that the deposits that went through was deposit number 44 and 45. So that means I'm missing 2 deposits, okay? 46 and 47, which in this case was $300 and an additional $450. So in this case, I'm going to make a reference that this is deposit number 46, which is a total of $300. And then the deposit of 47, which is a total of $450. Okay. All right. So then our next step here is to determine, well, since we're going to be subtracting or less, we need to subtract out the outstanding checks. So here I have a total of 1, 2, 3, 4, 5 checks I've written out. And let's compare it to my actual bank. My bank has only recognized 1, 2, and 3 were cleared. So that means check number 104 and 105 for 50 and 125 are outstanding. So in this case, I have to record that I am missing check number 104 and check number 105. Okay, so in this case, check number 104 was for a total of $50, and then my check number 105 was a total of $125. So therefore, let's go ahead and determine what my ending balance is. So I go ahead and throw my equal sum here. I'm going to highlight and click all of these right here. So I'm going to go ahead and start with $850, right? I'm going to add 300. I'm going to add 450. I'm going to subtract 50, and I'm going to subtract 125 to get a grand total of 1425. Okay? That doesn't stop here because I could find a discrepancy somewhere in my accounts. So then here on my cash ledger, let's go ahead and take a look at my checking account. My checking account tells me cash ledger ending balance as of May 31st was a total of $1410. Okay, so there you go. $1410 is where I'm going to start. And of course, when I'm dealing with my cash side, I'm dealing with interest and my fees. So let's go ahead and take a look at my bank account. Interest, so I have interest and I have auto clearinghouse. Interest was for $25 and my auto clearinghouse was $175. So I'm going to go ahead and write that in here. Interest was $25, while my auto clearinghouse was for $175. Okay. Now I need to look at my service fees that I was charged. So in this case, I got charged $100 for service. I wrote an NSF for $50, and I got a return check fee, okay, for $35. So in this case, I've been writing a lot of faulty checks here. So 150 and 35. Okay, so let's talk about the service charges. Okay, so here you go. Service charge was $100. And then I got NSF fee for, I think it was $50. NSF fee, yes, $50. And then my return check was $35. Okay, so let's go ahead and add these all up together. Okay, so once again, what you're going to do is you're going to start with your account balance with $14.10, right? You're going to add $25 for interest and add $175 for the auto clearinghouse, and then you're going to subtract your service fee of $100, subtract that $50 NSF, and then subtract that $35 for the return check fee. So in this case, I should get a grand total of $14.25, which, behold, success, right? If we look at our ending balances, they match on both sides. Okay, so once again, I want you to use this information or use this example here, because this is a perfect example of what I'm going to be asking you. Even the tables are going to look similar because, again, Orbun doesn't let you post a bunch of pretty things on there. They just basically allow you to insert tables. So that's what's going to happen. I'm going to have 3 tables on there. One for the bank statement, one for the check register or cash ledger, whichever one is there, and then the other table to be able to solve for the adjustments. Okay. And that is it for the Chapter 9 and 10 review, right? Chapter 9, we've looked at petty cash, how to establish it. Chapter 10, we got a review, we got the receivables, we got the bank reconciliation, as well as the interest. Okay? All right, so let's go over the last thing I have here, which is going to be your the depreciation methods. Okay, so down below, I have 4 examples of 4 depreciation methods here. Okay, so here, depreciation, we're going to go ahead and do a look at all 3 depreciation methods and 1 amortization method. Okay, so this example here says that you purchased a machine for $2,050 with a $500 salvage value. Okay, its useful life is 7 years, and it can produce up to 25,000 units. All right, and you put this machine into service as of June 12th. Use the units of production method. Okay, so here, the idea here is that we have the units of production method. So this is what it looks like going on forth. Okay, this is what it looks like. Okay, I'm going to insert a couple lines in here in case I need some extra space. Okay. So again, units of production, right? So let's go ahead and fill in our table here. What did I buy? I bought a machine, okay? And how much did it cost me? It cost me a total of $2,500, Okay. It has a salvage value of $500. Okay. Right. Its useful estimated life is 7 years. Its number of units that it can produce is 25,000 units. And the date that it placed into service was June 12th. Meaning it's gonna start on its first year only half of its life. Okay, because we're gonna start, our assumption here is that it's June 12th. So that means we are going to be depreciating it starting the month of June. Okay. So let's go ahead and solve for this depreciation method here, or depreciation basis. So the depreciation basis is going to be, in this case, it's going to be your asset cost of $2,500 minus your salvage value of $500. Okay, to give you a total of $1,550. All right. Your rate's going to be your depreciation basis divided by the total number of units that it could produce in grand total. Okay, which gives us a total of 6 cents. Now, of course, if I expand this table here and expand my numbers, right, it's going to actually be 6.2 cents. Okay, so this is where I'm going to use my equal round so that I get good numbers, right? Because my depreciation expense is going to be my rate. So let's go ahead and equal round. My rate times the number of units I produced that year. So in this case, I produced a total of 1750 that year. All right. So then I put a 2 here, and I get a grand total of $108.50. All right. And then, of course, because it's the first depreciation year, your accumulate is going to reflect the same. So then what is going to be my total book value? So I'm going to take my 2,050 minus my 108.50, and that's going to give me a total of $1941.50. Okay. All right, so then let's solve for year 2. Year 2, what's your depreciation basis? Once again, it's going to be my asset cost of $2,050 minus my salvage value of $500. Okay, which is going to give me the same exact number that I had for the first year. So in this case, if you guys remember, the depreciation basis stays the same throughout the whole entire year. Okay, and now it's time to solve for the rate. The rate's going to be depreciation basis divided by the total number of units that it can produce, which gives you the same exact number. So in this case, I also know that it's going to stay the same throughout all 7 years. Okay, that the rate's going to stay the same, right? It's going to be 6.2%. Okay. And then now the only difference here is going to be solving for the depreciation expense. So in this case, now that year 2 rolls around, we were able to produce 3,500 units for the second year. So once again, you're going to enter in your formula. It's going to be your rate times the units that you produced that year, okay, comma 2. This time I used $217, okay, for depreciation expense for year 2. All right. And then let's take a look at here. Let's solve for the accumulated depreciation, right, which is your previous years of $108.50 plus the current years, which is $217, to give you a total of $325.50. So once again, your depreciation, or I'm sorry, your book value is going to be your $2,050. Subtract out this $325.50, and you should get a grand total of the 1724.50. Right? So let's go ahead and solve for the depreciation expense for year 3. Okay? So once again, it's going to be my rate times the number of units produced, which is 3,800 units, to give me a grand total of $235.60. Okay? Accumulated depreciation is going to be your previous of $325.50 plus your current of $235.60 to give you a total of $561.10. Which then minus that from your 2,50, you should get a grand total of $1488.90 as your book value. Okay. So once again, let's solve for year 4. Year 4, this time you produced 4,000 units. So in this case, right, 4,000 times the rate of 6.2 cents gives you a grand total of $248, which, again, you're going to add that to your previous year's depreciation expense of $561.10 to give you a grand total of $809.10, which brings your book value down to $1240.90. Okay. So then this time on year 5, we end up producing 4,300 units. So we're just keep going and for doing mass production a lot quicker this year. Okay. So then again, in this case, year 4 rolls around. For the 4,300 units produced, we get a grand total depreciation expense of $266.60. Okay? Which, if we add that to our previous balance of $809.10, you should get a grand total of $1075.70. Which, again, subtract that out of your cost of the asset, should leave you a book value of $974.30. Okay. Almost done here. So the depreciation for year 6 is, so this time, I only produced 4,100 units. Okay. I only produced 4,100 units. So again, that's going to be a total of $254.20 of depreciation expense. So if we add that to our previous years of the $1075.70, we should get a total accumulated depreciation of $1329.90. All right, which if I subtract that out of my asset cost, will bring me down to $720.10. Okay. So go ahead and let's complete the last one here. This time for year 7, I was able to produce a total of 3,600 units. Okay, which brings me a total depreciation expense of $223.20. Okay, we add that to our account balance of $1329.90 to get a grand total of $1553.10. To give us a grand total here of book value to be $496.90. And here, we can't have that because our salvage value is $500. Our book value fell below this threshold of $500. So in this case, maybe we did actually end up producing way too much. So in this case, right, I'm going to go ahead and cross this out. So then we know that this is not the correct number. So strike through. Okay. And now we need to actually solve for the actual amount. In this case, I'm going to go ahead and I'm going to take a look at how many items I actually have in grand total. Okay. In this case, I have a grand total of 25,050. So therefore, I produced 50 units over. Okay, so if I produced 50 units over, therefore I need to subtract it out from this amount because I went over my capacity of 25,000. In this case, that means for this year 7, I'm supposed to actually get it to be, this one I have to strike through too because I can't produce 3,600. I can only produce 3,550 units. Okay? So if I carry that across 300 and 350 units, right? With my rate of 6.2, right? That should get you a grand total to be $220.10 worth of depreciation expense. I'm going to add that to my previous years of the 1329 to give me a total of 1550, right? To give me a grand total of $500 in my book value. So therefore, I can either go forwards or I can go backwards depending on which method you are doing and which one you're more comfortable with. So in this case, I solved it using by totaling up the sum of the totals of the exact amount of units I produced. Okay, and there we have it. All right, it is for this is how you do it. Okay? So that is units of production. All right, now we're moving on to our next method here, which is going to be the double declining method. Okay, so here our scenario for number 2 is that you purchase a laptop for $890 even, which includes all sales tax and stuff, and it has a salvage value of $50. Okay, its useful life is 7 years. Okay, and you put this laptop into service as of January 8th, so use double declining method. Okay, so let's plug all our numbers in here. So again, or our information here. So in this case, we bought a laptop. Okay, it cost me $890, right? Which we were able to get a salvage value of $50. Okay. And of course, the number of useful life it has is 7 years. And the date that you placed into service was January 8th. Okay. So therefore, if it's January 8th, and assuming that we are depreciating it from each year, right? That means January all the way to December is going to be one full entire year. Okay, so there's no partial years that you have to focus here on. Okay, so let's take a look at our little problem here. I'm going to add a couple lines just in case. Okay. So let's talk about the very first one, which is going to be the depreciation basis. So in this case, our depreciation basis is going to be the beginning of the year's book value. Okay? In this case, since I'm starting my depreciation as of the very beginning of its life, therefore, the value of this is going to be the asset cost itself, right? That's your book value. $890. Okay? Your rate here is going to be 1 over its estimated useful life, which in this case is 7. So that should give me a total of 1428. Okay? So this is where we need to use our equal round formula so we can get a nice rounded number. In this case, my depreciation expense is going to be my basis times my rate. Okay, times 2, or not times 2, comma 2, to give me a total of $127.14 for the year. In this case, yes, I did depreciate it for a full year because I put this asset into service as of January 8th, which tells me I'm going to start depreciating as of January. Okay. So again, the assumption here is the first year, so the accumulated depreciation is going to be $127.14. So therefore, my book value, okay, is going to be the asset cost of $890, okay, minus the accumulated depreciation of $127.14 to get you a total of $762.86. So this is the end of the year's book value, okay? So then if that's the end of the year's book value, that automatically becomes the beginning of the year's book value. So you're going to be transferring the information over here. Now, once again, the rate again is going to be 1/7, which we already know is this 14.2851. So in this case, we know for a fact that it's going to stay consistent all 7 years. So in this case, the depreciation expense, once again, is going to be equal round. You're going to take your depreciation basis times the rate, comma 2, to get a new grand total of $108.98. Okay? We're going to add that to our previous balance of $127.14 to get a grand total of accumulated depreciation of $236.12, which brings my book value down to a total of $653.88, which becomes my book value or my depreciation basis for year 3. Okay, so now my basis is shrinking, right? So therefore, if I multiply it by the rate once again, my depreciation expense for year 3 is going to be $93.41, right? We're going to add that to my previous accumulated for $236.12 to give me a grand total of $329.53, right? Which then drops my book value down to $560.47, which once again becomes my beginning of the year's book value for year 4. Okay. So once again, this time we're going to be multiplying the depreciation basis again, which gives us a total of $80.07. We're going to add that to my $329.53 to get a grand total of $409.60. And of course, that's going to bring my book value down to a total of $408.40. Okay. Continuing on with year 5 here. Okay. So again, year 5, our depreciation basis is $480.40. And we're going to times that by our rate to get a total expense of $68.63, which we're going to add that to our previous balance of $409.60 to get a total of $478.23. Okay, which brings my book value down by a total of $411.77. Okay. So year 6 is going to roll around, okay, for $411.77, which in this case, it already picked it up for me. That's going to be $58.82, which in this case, what is my total accumulated depreciation? is going to be a total of $537.05, which Excel recognizes what I'm doing here and notes that it is a total of $352.95 for my book value. Okay. Which then becomes my depreciation basis for year 7. And I can add that there. So then it gives me a total of $50.42 for my expense, which then again, it gives me an accumulated depreciation of $587.47, which brings my book value down to $302.53. Now notice this. I'm depreciating it. This is double declining, right? Okay. Okay. I get what I did wrong. I've been multiplying it only once. The rate here is actually going to be 1 divided by 7 times 2. Okay, so there you go. It's actually 28.57 instead of 14. All right. Excuse my mistake, guys. So therefore, this number right here is, okay, so all of this is wrong. So once again, it's going to be 1 divided by 7, because this is double declining, right? We need to multiply it twice. So there you go, 28.57. Okay, so therefore, let me see if I can be able to fix all this. Okay. So here we get the depreciation basis of $890 times the rate of the 28.5714 instead of the 14, because that's only looking at it once, right? We're double declining it, so it's going to be depreciating it twice as much. In this case, right, we get $254.29, which lowers my book value down to $635.71, which I cell referenced, so it copied that over. And then again, if I multiply that, it's going to be 181, which brings my accumulated depreciation to be $435.92, which brings my book value down to the $454. So in this case, this is the corrected one. I'm so sorry. I completely messed that one up. But in this case, because I used Excel, it's easy to fix mistakes, right? You just refix it, and this should be the correct numbers here, right? So here on my 7th year, that's why I was kind of thinking, whoa, I didn't think we had to run it that long. So in this case, on my 7th year, right, because I put this into service as of January 8th, right? It's already been 7 years old, and now it is down to $84.43, which we've already stated that the salvage value itself is going to be $50. So in this case, this is a laptop, okay? By the 7th year, you have the choice to either dispose the asset, right, which I've already explained to you. You could find out how to do that through your readings. You can properly dispose the asset, and note that if you are going to sell it or you're going to just write it off as scrap metal, then you're only going to be losing out $30-something, right? Because it's right now it's valued at 50, or you're supposed to have a value of 50 at the end of 7 years. And now, right now, you have $84. You can even run it again for 1 more year, if that's the case that you want to do. So if I were to run it down 1 more year, okay, starting with $84, $4.43. I would see at 43 cents at a rate of 0.2857, then I'm going to depreciate it for an additional $24.12, which then gives me a total accumulated of $829.69, which leaves me with $60.31. Okay, so in this case, even if I did it for another year, I'm still with $60.81 At this rate, a laptop that's exceeding way above its expected estimated useful life, you already know it's technology. It's going to be super slow. You're not going to be able to run anything there. The Windows update that has for every laptop is not going to be available anymore. So at this point, you're better off to just dispose it and buy a new laptop. Okay? Just because it's not worth keeping it that long because of, again, with advanced technology and just thinking of how a laptop works, right? You definitely want it to process things a lot quicker. But again, at the end of its life, it usually should be slow, and you have to determine whether you want to keep it or not. Okay, so in this case, go ahead and pause the screen here to just double check your answers. But this one should be the correct one again. So again, I'm sorry for that. I mixed up the methods here. So that was double declining. So now we're going to head on to straight line. So again, if you guys remember, straight line was a mix between the units of production and the double declining method. Okay. So then in question number 3, it says here that you purchased a table set for $770 with a salvage value of $70. Okay, its estimated useful life is 7 years, and you place this into service as of August 21st. Use the straight line method. Okay, so in this case, we have a few pieces of information that we need to make sure we're aware of. The asset that we bought was a table. Okay. Here, it cost me $770 for the asset. Okay. And of course, it has a salvage value of $70. Its estimated useful life is 7 years, and the date that you placed into service was August 21st. So in this case, this is August 21st. So what kind of indicator does it tell us that when are we going to start depreciating it? Okay. In this case, right, August 21st, it fell after the first 15 days. So therefore, we're going to depreciate it for the month of September. So that's going to be key information, because if we're assuming that depreciation is going to be done at the end of the year, then that means if we're starting to depreciate this asset start of September, October, November, December, it's only got 4 months to begin in the first year. So let's go ahead and run our formulas here. So again, this one, the depreciation basis is going to be the same as our units of production, which is going to be the asset cost minus the salvage value of $70 to give us a total of $700. Okay. The rate this time is actually going to be 1 divided by 7. Okay, so this one is right. It's going to be the 1428. All right. So then now, again, we need to use the depreciation, the equal round to solve for the depreciation expense, which is going to be 700 times the rate, okay, times, okay, you have to remember, because we're looking at partial years, since it's not going to be for the full year, we need to consider September, October, November, December. That's 4 months out of 12, all right, comma 2, to get me a grand total of $333, $33.33 worth of depreciation expense for this first year. And once again, we're going to acknowledge that. And therefore, my book value, which is your asset cost minus 3333, should give you a grand total of $736.67. Okay. All right. So let's solve for the depreciation expense for year 2. Okay. So here we note that the depreciation basis is going to be, once again, your asset cost of $770 minus your salvage value of $70, which gives you a total of $700, which, if you guys remember, in this case, for straight line, you should have remembered that it's going to be the same all 7 years. The rate is also going to be the same for all 7 years. Okay? And then let's solve for this depreciation expense for the second year. In this case, I'm going to again run my formula. So 700 times the rate, comma 2, gives me a total of $100. Okay? So if it's $100 every year, therefore we know it's going to be $100 for the rest of the 7 years. Okay? So now we got to solve our accumulated depreciation for each year. So in this case, what's 100 plus 33 gives you 133.33, which then brings your book value down to 636.67. Okay? Same thing for year 3. If I have to add another 100 this, it's going to be 233.33. All right, which is going to bring my book value down to 536.67. Okay, and so on and so forth. So now you can see a trend, right? Because you're adding 100 every single time. So therefore, the next 7 years, I'm going to be adding 100 each time. So that means the next time it's going to be 333. Next time it's going to be 433, 533, 633. Okay? So therefore, that's also going to decline your book value by 100 every single year. Okay? So there you go. I am now down on my 7th year. I am now finally reached 136.67. Okay? Now in this case, right, how old is my asset? My asset is only, 6 and 4 months old, right? Because the first year we calculated this, right, we only calculated that we got a grand total of 4 months, right? Because we're starting as of August 21st, which tells us that September, October, November, December. So it's 4 months. Now it's in the company, it's been using for 7 years. All right. But in this case, the asset's only 6 and 4 months old. So therefore, it can go for an 8th year. All right. You still get the same number, 700 here, and you still get this 1.428. But this time, instead of being 100, it's actually going to be equal round here. Right? Times, let me see, 8 divided by 12 because it already used its first 4 months. So therefore, there's a remaining of 8 months left, comma 2, to give me a grand total of $66.67. Okay? Which of course, if we add that to my accumulated, I get a total of $700, which leaves me with a $70 ending balance in my book value, which equals to my salvage value. And that's how we have to do it, right? This asset is exactly now 7 years old. All right, and now we reach the end, which is our salvage value is equal. Okay, so that's straight line for you. Okay. Last but not least, it's going to be amortization. Okay, so if you guys remember from our lesson for amortization, we know that amortization is going to be treated the same exact way as straight line. Okay, the only thing that we don't have is there's no such thing as a salvage value. So in this case, question number 4 says that on October 10, you decided to purchase a license for $556. So what did you buy? You bought a license. Okay? And it cost you $556. Okay? Of course, it says its estimated useful life is 15 years. And the date that you place into service is October 10. So that means you're going to depreciate it as of October 10. Okay? So let's take a look at this. We have $556. Again, there's, $556. There you go, $556. And no salvage value, okay? So let's go ahead and solve for year 1. Okay, so depreciation basis, again, is going to be your asset cost. Okay? Your rate is going to be 1 over its estimated useful life of 15, okay, which gives us 0.0666666667. So therefore, I'm going to use my equal round one more time because in this case, right, depreciation expense is going to be basis times rate, comma 2, which gives you a total of $37.07. Which we know from it's been our first year of depreciating. So therefore our book value is going to be the 556 minus the 3707. So they give you a total of $518.93. Okay. So as you can see, I'm not going to make you guys do all 10 years or all 15 years. So let's just go ahead and complete the next couple ones. Okay. Now notice this. This $37.07, right, is for the whole entire year. We can't do a whole entire year. In fact, that's not what it is because in this case, right, we need to remember that we placed this asset into service as of October 10. Or in this case, right, the day that you purchase it is going to be the day that you actually start depreciating it. So in this case, $37.07 isn't actually correct. I actually have to go back and think about it. So in this case, if it's October 10, I need to depreciate it starting October, September, October, November, and December. So in this case, I need to make an adjustment here because I am not depreciating it for the full year. I'm going to depreciate it for only 3 out of 12 months. And that's going to now leave me down to $9.27, which that is taken out from my actual cost to bring it down to $546.73. So it is very important that you remember when you place into service because October, November, December, that's exactly what you have to do. You have to remember that because it acts the same exact way as straight line, you also have to remember that you also have to be aware of when you place it into service. Okay? Okay? So once again, your depreciation basis is going to be your asset cost. So of course, if you remember, if it's anything like straight line, your asset cost or your depreciation basis is going to stay the same. Your rate is also going to stay the same. And now let's actually solve for what it costs for a whole entire year, which we know what it is, right? We know it's going to be for the $37.07 for the whole year. And because of that, that means the next 3 years after that, it's all going to be $37.07. Okay? So now let's go ahead and solve for the second year's accumulated depreciation by adding the $9.27 there to give you a total of, whoa, that's not right. So $37 plus $9.27 gives you $46.34, which brings your book value, again, is going to be your asset cost of $556 minus your $46.34 should give you a total of $509.66. Okay. So same idea here. We're going to add our 46 to the 37 to get us a total of $83.41, which brings my book value down to $44.7259. All right. Again, for year 4, we're going to add 83 to 37 to give us a total of $120.48, which then brings my book value down to $435.52. Okay. Last but not least, we're going to do we're going to add the 120 with the 37 to get you a total of 157. All right, to give you a book value totaling $398.45. Okay. All right, so that is the conclusion to everything that we learned in chapter 9, 10, and 11. Okay, so again, depreciation, we took a look at all 3 depreciation plus amortization. Now, of course, because amortization is identical to straight line, I'm not going to test you on that because it doesn't matter. It's the same result, right? As long as you know that for amortization, it acts the same as straight line. Okay? So, again, tomorrow we're going to go over the study guide. It should be already posted for the midterm. And after you take your exam, we're going on Thursday. I'm going to go ahead and start uploading a few extra documents that you need for the following week. Okay? All right. Other than that, okay. Well, that's it. All right.